Welcome back to Keith Talks, guys. My name's Keith, and in this channel, we talk about everything investment related, from stocks to cryptos and beyond. So let's talk. You guys can follow me on my social media channels in the description area below. If you haven't already hit that subscribe button, please hit that subscribe button, smash the like button for the YouTube algorithm, and don't forget to hit the notification bell. So with that, let's get started. Alright guys, so today in this video, I'm going to give you a brief description on why I'm holding Alibaba stock. And this video is going to be just strictly about the numbers of Alibaba, not the business, but I'm going to mention some things that are very important about the business. Now, before I begin, I know, yes, this is a Chinese company. There's a lot of bad news going around about Alibaba stock because of all of the other stocks that were delisted, like Luckin Coffee and Didi. But you guys have to understand that these companies actually committed fraud, and they weren't around for a long time. They were around for a short amount of time, and shortly after they IPO'd, within a year or two, is when they get delisted. But when you look at something like Baba, it's been around for years. They IPO'd years ago. So really, the trust has already been built there. Not to mention, the biggest fear right now that people have is that they think that Alibaba is going to get delisted just because of the structure. And you can actually find other YouTubers, amazing YouTubers, who've laid out the proof as to why Baba won't be getting delisted and why a lot of the news that's been coming out is just not true. It's actually fake news. Now, I'm sure you guys can go and do your own research on that, and you'll see that it's true, that most of the things that are coming out about Baba stock are just not true at all. That being said, now let's look at the numbers for Alibaba stock. Now, when I pick a stock, the first thing I do is I look at the market cap. I like the fact that Baba is a large market cap, because when it comes to smaller market caps, it's hard to tell if they're going to be able to make a large growth the next year. But when you look at a company that's been around a little bit longer, it's kind of easier to predict that they can consistently grow if they've been showing a history of consistent growth. And Alibaba is a over $300 billion company. Now, the second thing I like to do is I like to look at the PS ratio, the price to sales ratio. I just like to get a quick idea of how much money they're actually making, and then I take that money, the revenue that the business is making, and then I compare it to the market cap. So how much bigger is the market cap compared to the money they're making in revenue? That's pretty much what the price to sales ratio will show you. It's basically the market cap divided by the year's sales. Now, usually a fair number is between 4 to 7. Of course, depending on the industry, it is different, right? If you're looking at retail stocks, you're not going to see a PS ratio of 7. If you're looking at a tech stock, you're not going to see a PS ratio of like 4 to 7 at all either. Each industry has their own unique standard, and you got to look at its competitors and to find out what the average standard is in that industry, and then you got to kind of assess where the company is. Now, the third thing I like to look at is the PE ratio. I like lower PE ratios. I know with tech companies it is difficult to do that, but then when you're looking at a large cap company, it's actually reasonable to assume a pretty low PE, just because most people's outlook on the company, because it's so big, is that how much bigger can it get? So there's less people who are driving up the value of the stock. Therefore, they usually have pretty good PEs. Now, another thing I like to do is I just like to find the liquidation value, because I want to know, hey, if this company was to get sold out completely, and that's not going to happen with Baba. I actually, I'm heavily invested in Baba, and I believe this company is going to do very well in the long term and in the short term, hopefully too. Now, basically what you do to find the liquidation values, you just take the current total assets, and then you find the intangible assets, and then you just subtract the both and then you get a number, and you can take that number and you can actually divide it by the total number of shares, and then you can find out how much a stock would be priced at, and that would be the price of the liquidation value in terms of like how much it would be dollar per share. And I can take that and compare it to how much it's worth right now. Now, I know when it comes to tech companies, it's really difficult to do that, but it's just good to know that number, because if that stock price ever hits that number, that means, oh my God, you're getting an amazing deal. And if it's below that, you're literally a value investor. Of course, it is extremely difficult to find these kinds of stocks, and most of them don't exist, but it's a good idea to see how much more you're paying from the liquidation value. And that's what I use that metric as. I just like to see, if this company were to get completely sold out into different parts, well, what's left there? What goes to the investors? It's good to know that, so I want to see that, right? I'm not a true value investor. I don't really buy 50 cents for $1. That's not really what I do. But I like to see these numbers just because it gives me more conviction on what I'm buying. Now, the next thing I like to look at is actually the return on capital for the company. Now, how do you find this, right? So I can take something like a 5-year average return on capital, and it should usually be like over 10%. Basically, it's your net income, subtract your dividends, and then you just divide it by whatever debt and equity is in the company. And then that will give you a percentage. If that percentage is high, that means the company knows exactly what they're doing. They're taking the money and they're properly using it and reinvesting it into the right things. If it's a pretty low number, then the company has no idea what they're doing, and it's probably something you should be looking out for. Now, the next thing I look at is revenue growth. And if you look at Baba's revenue growth, it is astounding. It is consistently growing year over year between 20 to 30%. Last 4 quarters combined together for this year, Alibaba has already made about $127 billion in revenue. And then if you look at the last 4 quarters for 2020, they made about $90 billion in revenue. And then if you look at the 4 quarters before that, they made about $69 million in revenue. And the 4 quarters before that in 2018, they made about $48 billion in revenue. They are growing an astounding amount, guys. If you look at the 2013 report, the last 4 quarters, they actually made $3 billion. So they're consistently growing at a large amount. And this is partly due to the fact that they've also recently started doing cloud services, just like how Amazon has their cloud services. Now, Alibaba also has that. Plus, Alibaba has Alipay. Just like how Apple has Apple Pay or Google has Google Pay. So all of these extra businesses are driving in high and demanding more revenue. When I see a high percentage consistent growth of revenue, that attracts me more than anything else on the income statement. It's not just the revenue, but it's also like their profit share. Like it's been consistently growing every single year. Now, the next thing I look at is actually dilution. I'm very, very careful about this because I've been burned by this before. This is why I like going after companies who have a little bit larger cap, just because smaller companies, when they heavily dilute out of nowhere, you pretty much lost your investment right there. So dilution is basically when they're creating more shares out of thin air, and then you pretty much end up owning less of the company. Even if you bought 10 shares, maybe now, even though you still have 10 shares, there used to be 100 shares in total, but now there's like 120 shares in total. Therefore, you don't own 10% anymore. Now you own much less than that. So if the company is growing, you think your shares are gonna grow at that same pace, but it's actually not because of how much you were diluted. Now, when you look at Alibaba stock in the last 5 years, from about 2017 to 2021, they originally had a total outstanding number of shares of 2.6 billion shares. And today in 2021, they have about 2.7 billion shares. Now, they have diluted some amount, but it's not big enough to be scared or to be worried about not getting a good return on your money. Guys, the next thing I look at is, can this company actually outlast a recession, right? Of course they did during the pandemic, and that's a bullish sign for me. Well, how or what was the reason for them to be able to outlast a recession? And the biggest reason that most companies are able to outlast a recession is simply just cash flow. Does the company have enough cash flow, like free cash flow? Now, another thing I like to look at is how many businesses does this business actually own, or how many different ways of money or revenue are they actually able to generate? Now, when you look at a company like Amazon, they have multiple streams of income. When you look at Facebook, they don't. The biggest revenue generator is marketing. Of course, it's amazing, and Facebook has done amazing based on that. If they're just making money slowly on one thing, then they haven't actually yet grown into other sectors. So that is a possibly good thing, because that means the company has yet more potential to grow in the future. So I just want to see where they are in their life cycle today. And when you look at a company like Baba, well, there's a few businesses that they actually have. They have their China commerce retail companies like AliExpress, Sunart, and so on. They actually own a logistics service company. They have local consumer services websites in China. They have their Alibaba.com website and Alibaba wholesaling. Not to mention that they actually do cloud computing, like I mentioned before. And they even do digital media and entertainment, and a slew of whole other ways to generate revenue. Honestly, at today's price, Alibaba's market cap is only about $337 billion. And guess what? Their revenue, like I said, is $127 billion right now. So then if you look at it, the price to sales ratio, what I mentioned earlier, is less than 3. It's about like 2.5, 2.6-ish. Right, that's pretty low, even for the industry that they're in. Amazon's PS ratio is like 4, and they're almost a $2 trillion company. Alibaba isn't even in the trillions, yet they're making so much in revenue. So yeah, guys, when you look at the balance sheet, when you look at the income statement, and when you just look at the numbers of Alibaba, it is, in my opinion, severely undervalued. And that's one of my biggest reasons for actually holding it. And sometimes when a lot of people, especially out there in the media and news, they talk crap about a specific industry, everything in that industry will usually tend to go down. And when that happens, a lot of good stocks go down as well. So guess what? Baba is one of those good stocks because China has been having a bad rep for the last few years. Well, guess what? This is a great buying opportunity for me, and that's why I bought into Alibaba stock. I really hope you guys found some value in my video. If you did, please hit that subscribe button. I would appreciate it very much. Thank you guys so much for watching my video. My goal in this channel is to reach 1,000 subscribers. So like I said, if you haven't hit that button, go ahead and do it. Thanks for watching, guys, and take care.